So hello and welcome everyone to our Tax Basics webinar for investors. Just sort of as an overarching how this session will run is that we'll go through a few slides, share some information with you, and in the end we'll have a Q&A session where we will try to answer all your questions. If you could ask any questions in the Q&A section of the website, of the webinar, that would be great, rather than the chat, because then at least like that we have everyone or everything in one place. But yeah, so without further ado, we'll quickly introduce you to TaxScouts in terms of who we are and what we do. Stuart, can we have the next slide? Perfect. So essentially, we're an online provider of self-assessment tax return. But unlike many other providers out there, we connect our customers to a certified UK accountant who then files the return for you. So essentially, for a fixed price of 119, you get your own personal accountant, which is pretty good deal. From day one, TaxScouts have tried to simplify tax, and that is evident from the user journey. Essentially, we only ask a few simple questions. Where possible, we import your financials directly from the HMRC. We then ask for a few supporting documents, and once all the necessary information is collated, we then connect you with an accountant who completes and files a return for you. We also have heaps of content on our website, so if you have some spare time, feel free to jump on our website, browse around, or even chat to our support team. The next slide is just a quick visual to showcasing the simplicity of the service. But without further ado, I'd like to introduce your speaker. Stuart. Stuart is one of our accountants who's been with TaxScouts for a year now. And he'll be the one who'll talk you through the slides and who'll answer all your questions at the end as well. Over to you, Stuart.
Hello, nice to speak to everyone today. I'm going to keep the presentation, reasonably light touch, because obviously it's difficult to give out lots of tax advice before before anyone on the call is or isn't a sort of a client of mine. So lots of information, but please do take it at an arm's length basis. I've been working with TaxScouts for about a year now, but before that, I've been working in a range of different accountancy firms for over 15 years with individuals, so dealing with income tax and capital gains tax. So, brief agenda. What we've really seen during lockdown is a lot of people have a sort of new to becoming investors. I don't know whether this is a function of having too much time due to working at home through COVID, but we're seeing a lot of sort of new clients coming into the sort of the arena of self-assessment based on investment income. So this is just going to be an overall session to introduce some key dates of self-assessment, introduce a little bit of the sort of tax rates for certain investments. We're going to look at some efficient investments just briefly, so things like enterprise investment schemes, venture capital trusts, individual savings allowances, and then some Q&A at the end. So let's crack on. So some of the basics. So UK tax year is a strange one compared to the rest of the world. So it runs from 6th of April to following 5th of April. The tax return deadline, if you're filing electronically, which during COVID times we would obviously urge you to do, because HMRC's post is a little bit delayed at the best of times. In a COVID year, it's very delayed. So electronic deadline is the 31st of January following the end of the year. So you do have 9 months to get your information together, but as you can see on the slide, you can file as early as day one of the new tax year. Payment of tax is typically owed in January as well. The timeline there, if you're an employee and you pay some of your tax through PAYE on your employment income, and you find that you owe some income tax on investment income, then if you file your return electronically by the 30th of December, you can actually pay the tax in the next tax year through your PLE code. So you can defer that tax bill, but that deadline of 30 December needs to be met. It may well be that if there are sort of new investors on this call who are outside the scope of self-assessment at the moment, that, as I said, investment income can draw you into self-assessment. So broadly, 2/3 of UK taxpayers simply pay tax through PAYE on their employment income. When we think about investment income, there are a couple of sort of triggers that will bring you into filing a self-assessment tax return. Those are property income of more than £10,000 gross, or £2,500 after expenses, dividend or interest income in excess of £10,000, and or capital gains where the capital gain is more than 12,300 in the year, or you've sold assets and the proceeds of that sale are above 49,200, then you would be obligated to file a UK tax return. The last one, for anyone who is in paid employment, if you earn over £100,000 in the tax year, then you will need to file a tax return. And we'll come on to talk about that a little bit later, because that can impact some of the tax-free personal allowances that you receive. So tax on investment income, the level of tax you pay on things like bank interest or dividends or capital gains depends on how much other income you earn. So if you are an employee, your salary will be taxed at the lower rates of income tax, and investment income sits above that as top slice. Again, it's subject to the type of investment income you're receiving. So bank interest, dividends, capital gains. And there are obviously methods of holding investment income in tax efficient ways, which we'll come on to talk about. Just at the bottom of the slide, so income tax, you pay that on interest, a bit of a niche one there. If you are mining crypto, HMRC's opinion is that is like a job, and so that is subject to income tax rather than capital gains. Dividend tax, there isn't a specific tax in the UK legislation called a dividend tax, but there are slightly different rates. And then CGT, capital gains tax, is payable on the sale of assets, so shares, properties, cryptocurrencies, if you are buying and selling those but not sort of mining them, and any other assets you can think of. Some assets are exempt, and we'll come on to touch on that briefly. So income tax, hopefully the slide's pretty self-explanatory, but employment income or self-employment income, if you are self-employed. Similarly, as touched on briefly on the last slide, if you are, say, a day trader of stocks, shares, currency, crypto, then, if you're doing that day in, day out, then that would be looked at as a self-employment and would be subject to income tax. So income tax is also payable on some state benefits and grants, pension income, rental income, and income from a trust. Not going to dwell on those here. The current income tax rates are shown at the bottom of the slide. So a lot of people have access to a £12,570 tax-free personal allowance. That allowance is removed from certain people in certain circumstances, and we'll come on to address that. Income tax above that is at different rates depending on how much income you're earning. tax on dividends. So dividends are distributions paid from companies to their investors. So individuals who are self-employed but running their self-employment through their own limited company, they would typically pay themselves in dividends. Again, shares or funds that are listed, so public limited companies that pay out dividends, and also private companies that pay out dividends as well. The first £2,000 of dividends is tax-free. It's called the dividend allowance, and everyone is entitled to that. And it's not removed depending on how much income you earn. Above that, the level of tax you pay on your dividends depends on which tax bracket they fall in. So if you've got earnings of less than, say, 50,000, you're a basic rate taxpayer, you pay 7.5%. Above that, 32.5%, and then if you're earning over £150,000 per annum, it's 38.1%. So capital gains tax, we broadly think of capital gains tax as chargeable on the sale of assets. So as we said, property, shares, crypto, or other specific items, so antique furniture, antique paintings. There are some exemptions, which I'm not going to touch on too briefly, but if you say you sell a sofa and you bought the sofa for less than £6,000 and you sell it for less than £6,000, that's going to be exempt because HMRC just aren't going to allow losses on things like domestic items. And similarly, if you have an asset with a useful life of less than 50 years, that would also be exempt from capital gains tax. So you can't report the gain, you don't report the gain, but you can't report the losses. So things like cars, obviously, unless you're talking about luxury cars, 99.9% of cars would devalue, and so everyone would be reporting losses, which they could then offset against other gains. So those items are exempt from CGT reporting. There is a capital gains tax-free annual exempt amount of 12,300 for the year that ended on the 5th of April 2021. Similarly, as I said, some assets are exempt because they are either low value or they have a useful life of less than 50 years. The other sort of very beneficial exemption within the UK law is principal private residence relief. So you don't pay UK capital gains tax on your main home if you have always occupied it as your only or main residence. Now, there are some niche rules in there if you have been using part of that home as for self-employment, or if you've been letting part of it out. So if that situation applies, then it's best to take advice just to guarantee that the gain can be exempt. But yeah, I mean, it's a very generous gain, and it just simplifies things because, again, you don't have to, if you buy your home, you live in your home, you sell your home, you don't have to report that sale for tax purposes. The last point on the screen, again, if you are selling assets at a loss, then that loss can be reported and carried forward indefinitely and used against future gains. So do I pay the same tax on all of my investments? No, I think we've touched on that. Dividends are taxed slightly differently. Capital gains tax have different rates. There's a different allowance. So it's a mixed bag, and if you are confused by the rules, it's best to seek professional advice. So talking about tax efficiencies, but also we'll start with just tax allowances. So interest income, most individuals can earn some interest from savings in the bank without paying tax. Again, it's a moot point. I guess for the last 10 years, if not more, we've been in a very low interest environment, but every little helps in terms of not paying as much income tax as you need to. So the rate at which you pay tax on your bank interest really depends on the level of your personal allowance, whether you can access the starting rate for savings and the personal savings allowance, which I'll come on to talk about a little bit more. Again, we have talked about it earlier. The level of tax on bank interest does also depend on other income that uses up your lower rate tax bands. So the personal allowance, as we said, for income tax purposes, it's £12,570. You can possibly increase that allowance if you are married and your husband or wife earns less than their personal allowance, and also that you are only earning in the basic rate band. So if one individual is earning in excess of £50,000, then the marriage allowance cannot be claimed. Blind person's allowance allowable for individuals who are registered blind. And the other point with the personal allowance is if your income rises above £100,000, then the personal allowance starts to shrink on a sort of £2 of income reduces your personal allowance by £1. So if you earn in excess of £125,140, then your personal allowance has been reduced to 0. This reduction in the personal allowance was introduced all the way back from 6th of April 2010, so a good 11 years ago, but it's still catching people out now. So in January, we've had people coming through TaxScouts surprised that they owe tax of around £5,000. And that payment is because their PAYE code for the year that has applied on their employment income has allowed the personal allowance. And then in the tax return, that personal allowance is removed because the income is above 100,000, and that produces the tax payment owing. So my word of caution is if you have earned in excess of £100,000, then your P60 should be available from your employer because they have to be issued by the 31st of May. And so I would look at your P60, and you can put the income and tax amounts into a tax calculator. There's one on TaxScouts website, and that's just a double check that you have paid the right amount of PAYE. Because as I said, this can come as a surprise to individuals the first year they earn over £100,000. So the starting rate for savings, we don't see it very often. It's really just for individuals who have no other income sources apart from savings income. And if you're in that situation, then you can have your tax-free personal allowance of £12,570, and on top of that, you can have another £5,000 of bank interest tax-free. But as it says in the bottom bullet point, if you have other income over £17,570, then the starting rate is taken away. And in 15 years of working in personal tax, I don't think I've ever come across a taxpayer that has used that. So the personal savings allowance, depending on how ancient anyone on the call is, anyone that was earning bank interest prior to 6th of April 2016 might remember that UK bank interest used to be paid net of 20% withholding tax. And so if you were earning below the 20% band, you could apply to have that 20% withholding tax back. If you were earning above the 20% band, you would find that you'd owe an extra 20% or 25% with the tax return. What that really meant was that a lot of people were filing a lot of forms for very little tax in terms of refunds or tax payable to HMRC. So from 6th of April 2016, the Treasury changed the rules and allowed banks to pay bank interest to taxpayers gross. And alongside that, they introduced the personal savings allowance, which effectively, it's a small tax-free band for individuals depending on how much they earn, as you can see on the screen, but it's a simplification. HMRC do not want to be processing vast amounts of paperwork or tax returns for somebody that's earned £100 of bank interest. It's just not worth it. So again, depending on how much you earn, you will have a personal savings allowance that will allow you to earn bank interest tax-free. We've already touched on the rate of income tax that applies to dividends. Again, similarly to the personal savings allowance, the dividend allowance was introduced, again, as a simplification. It started off as £5,000 and then was promptly slashed to £2,000, presumably because too many self-employment people were paying themselves dividends out of their limited companies. But again, the tax rates are there and we've discussed those. Come on to discuss some other tax relief options that are available for investors. And again, in the last year, what we have sort of seen is the level of involvement in these types of vehicles increase. There are now tech companies that are doing this online, so things like SEIS or Crowdcube, and people are, they're becoming a lot more available in the market, I guess. And so, it's good to be aware. Obviously, the caveat with these relief is, by their very nature, the companies that you are investing in are risky. But so take any investment with a pinch of salt. I've not seen clients make a lot of money from things like EIS and SEIS, but I'm sure there are some that have. So if we touch briefly on the enterprise investment scheme, so broadly, individuals can invest up to £1 million per tax year in companies that qualify for enterprise investment scheme relief, and there are some good reliefs available, again with the caveat that this can be risky, and that I'm also not giving investment advice because I'm not qualified to do that. So when you invest in an EIS company, you can claim 30% tax relief up front. That's broadly in the year that you subscribe to the shares. You can also choose to carry that tax reducer back to a prior year. So as you can see on the slide, if you invest £10,000 in an EIS company, then you will receive a tax reducer of £3,000 that you will be able to deduct from your final tax bill of the year in which you made the investment or the prior year. There is no function to carry that relief forward. And so say that you hadn't paid enough income tax in either of those 2 tax years, then the income tax reducer would be lost. But even if let's say you weren't a taxpayer, but you wanted to invest in an EIS scheme, you should still claim the income tax relief, even though you have no income tax to pay, because if you haven't claimed income tax relief, then you cannot claim the CGT exemption. So the 3rd bullet point. And there was a case about this recently where the court basically said it's tough. The rules have been written badly, but it's tough. So the moral of the story is claim the income tax relief even if you don't need it. EIS is also useful as a deferral tool. So say you'd sold another asset, sold some crypto, and you had a £20,000 gain. You could defer that crypto gain into the purchase of a qualifying EIS company and just push the payment date out. It is a deferral. It's not that the gain stops being payable. It just pushes it out into the future. Again, the other useful point about EIS, assuming that the company makes money, is that the capital gains tax on sale of the shares is exempt from tax as long as you meet the qualifying conditions, which is broadly that you hold the shares for 3 years. There are more conditions dependent on the type of the investment, but those are outside the scope of this webinar. So if you are keen to go into EIS, then again, seek professional advice. The 4th bullet point is also quite interesting because if your EIS investment does fall to 0, then it is possible to offset that loss against either income tax, so employment income or self-employment income, which is obviously beneficial because those are at higher tax rates. If you don't have employment income or self-employment income, then you can offset it against CGT. Again, SEIS, so Seed Enterprise Investment Scheme, is broadly similar to EIS, but perhaps slightly riskier. And so you get a 50% tax reducer. So instead of £3,000 for a 10 grand investment, you get £5,000, but you can only invest up to £100,000 in any year. I think one point just to draw out that I didn't comment on, dividend income from EIS or SEIS investments is taxable. And that's in contrast to venture capital trusts, which we'll come on to talk about in a minute. Social investment tax relief, again, broadly similar. The government introduced this a few years ago. They're not sure what the take-up was, and so I think there's actually a consultation going on at the moment to abolish this. So it's perhaps not relevant. I've not come across any taxpayers who have used it, but you can see from the slide the premise is broadly similar to EIS and SEIS. VCTs, so venture capital trusts. I guess the broad idea of these is that rather than putting all of your eggs in one basket in terms of EIS or SEIS, VCTs look to spread the investments across a range of different companies. You can invest a maximum of £200,000 per year, and again, 30% income tax reducer. Difference here is that dividends from VCTs are tax-free. Capital gains tax is exempt, and so they're sort of deemed to be a little bit less risky, but again, with the massive caveat of these are riskier investments. Touch briefly on ISAs. Hopefully everyone is aware of ISAs, but effectively they are individual savings accounts. Lots of different types, which you can see on the screen there. So cash does what it says on the tin. Innovative finance, so a slightly riskier ISA that again is allowed to invest in slightly riskier activities. So as you can see, peer-to-peer lending, property or crowdfunding. The lifetime ISA that was introduced a couple of years ago, and you can put in a maximum of £4,000 per year, and the government will top that up with £1,000. And you can either use that to purchase your first home, or you can use it for retirement. I think they are closing lifetime ISAs. Well, sorry, you can't open a lifetime ISA after you turn 40. So it's perhaps best to open one now, and whether you use it or not, you've then got that option. Help to Buy ISAs, they've already gone, unless you were in them before November 19. Stocks and shares ISA, obviously in contrast to a cash ISA, stocks and shares ISA can hold stocks and shares. I've added this one in as well, just if anyone on the call does have children. The junior ISA, so children under the age of 18 can hold a junior ISA, and that can be in cash and or stocks and shares. The caveat with that one, again, this is not financial advice, but the money that goes into the junior ISA is locked up until the child turns 18, and then I'm pretty sure it's given directly to the child with no control from the parents. So for my children, I'm kind of holding half of their savings in my name and half in their junior ISAs, which I know isn't very tax efficient, but it's control efficient, shall we say. ISAs, again, the only sort of tricky point here is if you do leave the UK and become non-resident for UK tax purposes. Again, we're not discussing that on today's call, but broadly, if you go to work overseas for more than a year, you'll probably become non-resident. And so you cannot contribute to an ISA in a non-resident year. You can continue to hold the ISA, and the ISA can continue to grow on a tax-free basis for UK purposes, but you cannot contribute. And again, the income or gains from the ISA is outside the scope of UK tax, and so is outside the scope of UK tax returns. So again, a nice simplification. Pension income or pension contributions. There are tax advantages from a pension. So there is tax relief on the way in, broadly up to your maximum rate of tax, so broadly up to 45%. There are limits. If you are a high earner, then you may find that your annual allowance is reduced from £40,000 to currently as low as £4,000 for individuals who earn around the £300,000 mark. So again, if you're in that situation, then do take professional advice on the level of annual allowance that's available. Your pension pot can grow tax-free, fine, understandable. And under current rules, I say that because for those of us that have been doing tax a long time, I want to say that we're on our 6th or 7th sort of iteration of pension legislation since 2006. So that's why I've put this comment in there. It is constantly changing, and there's always some threatening language coming out of the Treasury in terms of where they're going to get their next sort of tax slice from. And as I said, we're 7 or 8 iterations in from in the last 15 years alone. Children's pensions, again, there is a nice little bonus there if you can contribute to a pension for your child, where you can put in £2,880 and HMRC will add another 720 to top that up to 3,600 for the year. Again, when your child turns 18, it becomes their pension, but because it's a pension, it's locked up until retirement age, which at the moment is deemed to be 55. I guess the other benefit of pensions is the UK's system of auto enrolment and sort of making sure that your employer is contributing to your pension as well. But again, all contributions, whether they are by your employer or by you personally, need to be measured against your annual allowance. And so, if you do want to put upwards of £40,000 into a pension, then it's worth seeking professional advice and just having someone, look at those numbers. So I appreciate we've kind of whistled through the slides, but perhaps the Q&A is more interesting.
We do actually have a few questions.
Okay.
First one, you mentioned being able to carry forward losses. Can we carry them back?
It depends which losses you're talking about, but if those are capital losses, so from buying and selling assets, then those would be carried forward against future gains. If you're talking about, I think the other carry forward, sorry, the other carry back point that we discussed was obviously the enterprise investment scheme or seed enterprise investment scheme tax reducer. But if you're talking about capital losses, you carry those forward.
Excellent.
Okay, so next question. If you have shares in a company and they IPO and you profit considerably, does it make sense to take your shares out over a number of years so that you can keep your CGT lower? Possibly. I mean, remember, if we're, and please take this at an arm's length basis, to your second point, where can you get tax advice from? Please feel free to reach out to me through my website if you would like to discuss this further. I guess with shares from employment, there's a couple of considerations. If you are paid in shares, then that is employment income. So if your company gives you shares worth £50,000 and you can sell those shares tomorrow, then that's employment income, and there is a PAYE liability. If you've paid your PAYE liability and you're holding the shares, you're then into a capital gains tax position. So let's say that you're given a share by your employer and that share is worth 100. You would pay PAYE at 40%, and then your base cost for that asset for capital gains tax purposes would be 100. If that share then goes up to 120 and you sell it, you've made a £20 gain, and that's chargeable to CGT. But yes, to your point, if you were sitting on a gain of, say, £50,000, yes, you could sell that over time and use the £12,300 annual exempt amount to reduce the CGT payable. There are different rules in terms of when you are selling and buying shares of the same type that stop you sort of artificially rebasing your shareholding. So, for example, let's say that you were sitting on a £12,300 gain, and you wanted to sell those shares on the 5th of April to wash out that gain. If you then repurchase those shares on the 6th of April, the law says that that transaction never happened, because you've bought and sold the same amount of shares and the same asset within a 30-day forward-looking period. So if you wanted to kind of rebase your shareholding using that tactic, you would need to be out of the market for more than 30 days. Or there's various other tactics which you can look up or take advice on, which would be either you sell those shares and your wife or husband purchases them, or you sell them and then your stocks and shares ISA repurchases them. But again, arm's length basis, take professional advice. To your second question, also, where is the best place to get tax advice from outside of the self-assessment, which I know TaxScouts offers? I mean, obviously there are various different ranges of accountancy firms out there, from the big four professional service firms right down to individuals like myself who are self-employed one-man band. If you Google UK tax advice, there are websites who have or who can put you in touch with accountants. Again, I'm on one of those websites that scores quite highly in terms of SEO. So feel free to feel free to reach out to me, and if I can't help you, then I can direct you elsewhere. It really just depends on the nature of the advice and how much you want to sort of spend. So question, I think you referenced this, but if I invested in EIS and SEIS in the last year, do I need to tell HMRC about these investments this year, or can I wait until I need to claim losses or CGT relief upon sale, say in 5 years? Well, to your point, if you have invested in EIS or SEIS and you have received the EIS 3 or SEIS 3 certificates, then you're probably due a tax reducer, and so you would need to either claim that reducer within a self-assessment tax return, or you can use, if you're only paying tax through PAYE, you can use the EIS 3 or SEIS 3 form to claim a reduction in your PAYE, either for a prior year, or they can amend your code for the current year. But yeah, I think if you have got an EIS 3 reducer, then you want to claim that as early as possible, because if there's a refund, then that money is yours. And given how we're seeing HMRC operate at the moment, things are just taking a lot longer than they would normally take. So, any refunds, it's best to get those in as soon as possible, because at the end of the day, it's your money. Just in reference to that Q&A, I've just scrolled back to this slide. One date that wasn't on here, if you do become, if your situation does become relevant for filing a self-assessment tax return, for, let's say, the year 6 April 20 to 5 April 21, then what the law strictly says is that the taxpayer has an obligation to get in touch with HMRC prior to the 6th of October 2021 to say, hey, my affairs have changed. I know that I need to file a tax return because I've got capital gains to report, or I've earned over £100,000, or I have dividend income. Please send me the relevant numbers, because to file a tax return, you don't just use your national insurance number. You need a separate record called a unique taxpayer reference number. And applying for a unique taxpayer reference number is also a service that TaxScouts offers alongside the actual filing of a tax return. So again, dealing with a lot of individuals who perhaps weren't aware that they needed to file a tax return, but unfortunately, due to the self-assessment nature of the UK tax system, as in the taxpayer is expected to know about their affairs or ask questions or seek advice either from HMRC or a tax advisor, often the first time that somebody might become aware that they are filing a tax return is when a penalty notice of £100 lands on their doormat, on the 5th of February. So again, I guess my last point to kind of hammer home is, if you think you need to file a tax return, I would check that now, because we're in a good time of year where tax year is finished, so you should be aware of your income, employment income, self-employment income, or investment income for that year. And similarly, you've got time to apply for the unique taxpayer reference number if you need to, because as I said, HMRC are a little bit all over the place at the moment. Okay, so that's all from me for now. But
just interrupt. There was another question on the chat section as well, actually.
Okay.
From resident non-domicile perspective, are all these investments, ISAs, pension considered as remitted money to the UK?
Okay. There's two questions from.
Yes.
Okay. Good questions. Complex questions. So again, if you are resident but non-UK domiciled and using the remittance basis, then I would suggest that we have a discussion outside of this presentation, because it gets quite complicated, but it is a field that I have worked in for 15 years. I do a lot of work with resident but non-UK domiciled people. But broadly, it depends. If the money that you're using to invest has come within the UK, then yes, it's been remitted. If you're holding a trading account outside of the UK and you're investing in non-UK investment income, then that's probably not remitted. If you're somewhere in the middle and trading offshore but using things like ADRs, then that comes with a huge dose of it depends, and I'd be happy to discuss that with you. I mean, ISAs, again, probably all onshore, so the funding of those would be from remitted income. Pensions, again, probably onshore. But again, it depends. Are there any specific rules how to distinguish share trading as income versus CTT if you trade a few times a week but not every day? Well, there is a TaxScouts self-employment genius on the call, and he will correct me, I'm sure. But again, it comes with a big dose of it depends. There's a lot of HMRC precedent in terms of what qualifies as a trade, so self-employment, versus what qualifies as CGT. But if you're in and out of the market a couple of times a week on an arm's length basis, probably look at that as a CGT position. If you're constantly in and out of the market every day, then it's probably a trade. But John Harris, who does a lot of work with self-employed, says or suggests CGT. We're really looking at day trading. Somebody that does it for a living, rather than a bit of time in the evening or weekends. But again, if that's something you're concerned about, feel free to reach out to me through my website, and if I can't help you, I can direct you to someone who can.
Excellent. I think that's all the questions for today. So finishing 7 minutes early. Excellent. Yes, thank you very much. As I mentioned in a chat, we will follow up with the slide deck and a recording of the webinar for everyone who's attended to refer back to. And then if you do have any questions, feel free to reach out to Stuart or come to our website as well, taxscouts.com, and we have an online chat available where you can ask some questions to our chat support team as well. Or you can email the support team directly at support@taxscouts.com as well. But yes, look forward to hearing from us with the follow-up emails and links. And thank you very much for your time today. And thank you, Stuart, so much for your help.
That's okay. Right. Thank you.
Goodbye, everyone.
Bye-bye.